Today we're going to be talking about liquidity and what it means for your trades. Jumping straight into a slideshow, the definition of liquidity is how easy it is to buy or sell something quickly without changing the price too much. So earlier today we spoke about volatility, which creates price movement, which us day traders rely on to make profits. Without volatility, price doesn't move much, leaving fewer opportunities for us to make trades. Now liquidity ensures those opportunities can be acted upon quickly because there's enough buyers or enough sellers in the market. Liquidity affects trade execution whether it's high or low. When you have high liquidity, it makes it very easy to buy or sell at the desired price you want it, whereas low liquidity can lead to slippage, which just means trades execute at worse prices that you intentionally wanted them to. Which essentially means you buy Euro USD at $1, but there's no one to buy it off you until $1.05, so you lose that 5 cents gap, and that's what slippage is. When volatility is high, prices can change really quickly, making it harder to execute a specific trade at a specific price, even in really liquid markets. What you want to try to do is find a balance of liquidity and volatility. If you have liquidity that's too low, you can't execute the trades at desired prices. Whereas if volatility is low, the market doesn't move enough for you to execute those large profits. There's three main factors when it comes to liquidity. The fact that you've got a quick entry and a quick exit to your trades, meaning you can capitalize on those short-term price movements, and it ensures that you can enter and exit trades without any delays. High liquidity means you've got less slippage, meaning your trade is filled out at the correct price without any movement in that original price. And finally, another subset of day trading is called scalping, and this is when you make a lot of small buys and small sells for smaller profits. This is always done on a very small time scale, and it's very dependent on not only high volatility, but also very high liquidity. As you're playing on such a small margin, any slippage could lose you a lot of your profits. Let's hop back on the markets quickly so I can show you exactly what liquidity looks like. In front of me here, I've got the Euro US dollar once again on a 5-minute time frame. As you're looking at the chart in front of me, you may see there's two low points that are very obvious. You've got this low point here at 10 past 8. I'll draw a quick circle around this. And another low point over here at 6:15 in the morning. Now, what do these two prices have in common? You might look at them and say, well, they both reach the same point. Well, that's where you'll be incorrect. If you zoom in here, you can see this first point here. I'll pop a quick horizontal ray to make this obvious. This first wick goes all the way down to right there at 1.03442. Now, if we zoom out and go over to the second wick, as you can see, it's actually gone below it. Now, what does this mean? Let's make things simple. Let's say you have 100 phones. You need to sell these 100 phones to one person or as many people as quickly as possible without changing too much. This is what liquidity is. You can't stay in the same space. I cannot sell 100 phones from my bedroom with no one around me. What I have to do is go to where people are looking to buy phones, and that's when I can sell the 100 phones as quickly as possible. Now, this is what liquidity is. The price is moving to a zone where there's people wanting to buy the price. So in this section here, you can see liquidity is just underneath this first price drop. So that the price has bounced off this support level, come down, and it's actually wicked below it to these traders here, who are all wanting to buy the price at a level lower than the original. The original being this price here. So what does this mean for your trades? When you trade, you want to look for levels of liquidity and volatility in an equal zone. The trade I'm showing you here is levels of very high volatility and at some points also very high liquidity. Now, where are these very high levels of liquidity? Liquidity is in this candle here. This orange circle that has a circle around it is where the liquidity is sitting. That's why, as you can see, this candle wicked, which is what I was talking about in the first episode, to below the support zone to take in as many of those buyers as possible. As the price wanted to go down, found all those buyers to sell the price to, and they bought the price, meaning the price is going to shoot up. Now, in your trade, what you want to do is find these levels of liquidity and place your trade at the level of liquidity. So if I were you, I would have seen that the price had come up and started coming back down to this low here. Now, I would have not only looked at this very low here, because there's also liquidity in between. As you can see here, price did the exact same thing, just on a smaller scale. Let's take a look at this trade here and this trade here. The first low happened there at 1.03485. The second low came in just below it to grab the liquidity and shoot the other direction. So if you're looking for high quality trades, you want to find levels with liquidity, and you don't want to look for levels without liquidity. Now, the levels without liquidity are going to be these levels here. This red shaded box I've done are the levels that have no liquidity, as the volatility is very high, meaning the liquidity is going to be very low. So if you tried entering a trade in the middle of this candle here, you may not have gotten the correct price you want and incurred some slippage, meaning your trade would have executed at the incorrect price. However, if you got in the trade a little earlier and got in the trade in this candle here, or even this candle here, looking for a buy, you would have seen that the price would go perfectly in your favor. Same with the other one on the larger scale. If we zoom out and go to this section here, so as you can see in this larger scale here, if you zoom in, we'll get rid of this box here. You've got this low level of volatility here, all the way up to this starting level of volatility at 6:05. This is all UK time. Now, if you'd gotten in a trade in this candle, or even this candle, it would have been feasible, as there's not a lot of volatility. However, if you would have gotten in this candle, you'd have incurred some slippage due to the high volatility, and same possibly with these candles up here. Now, you'd have wanted to enter the trade on this blue candle here. Now you may be asking why. The reasoning behind it is you don't want to predict the market because you may not always be correct. However, if you react to how the market is acting, you're going to have a higher likelihood of winning those trades. So in these two candles here, you can see the price go to a level of liquidity, find buyers, and reject. In this one candle here I've got the arrow pointed at, you'll see that the candle went down to an area of liquidity where the buyers were sitting, hit that area of liquidity and rejected. Now, that's your point. When the candle closes, after the 5 minutes is done, that is the time for you to react and place a buy order. Now, you want to place a buy order with a stop loss level below the liquidity that's just been hit and a take profit level of the next level of liquidity. This is what it would look like. This is something it would look like. If I get rid of this arrow here so you can see, this stop loss level is just below the previous liquidity grab. Meaning, if the price comes back down to that point, it shouldn't go past the stop loss level. And my take profit level is just above the next point where I could see liquidity being grabbed, as in above this point here. Now, this just happened to be a trade of 1 to 2, once again, like my previous trades. However, if you look back and don't mind waiting a bit longer for your trade, you could even have a take profit level of just above this level here. Now this would also be a correct level of liquidity, as the price has come up previously. You don't want to go too high above where the liquidity would be sitting, as then you could miss where all the sellers are sitting. Price could go up close to your take profit and reject. So if you wanted to reach a higher take profit level, I would advise to hit where the body of the candle closed, that you're looking to hit the liquidity from. In this case, the body of the candle closed at this level here, as we're looking at these two candles here for liquidity. So look for the low where the candle closed, as that's where it's likely to hit. So changing your take profit to that level there would have hit it nicely. That would have incurred you a take profit of 1 to 3, a risk to reward ratio of 1 to 3, meaning for every dollar you risk, you make 3. So on this trade, if you risked $100, you'd have made 300. So I'd like to thank you for watching this video all the way to the end. Like and subscribe if you'd like to see me do more of these educational videos. And as always, I'll see you tomorrow.